Please stay tuned for important disclosure information at the conclusion of this episode.
Hi, and welcome to The Long View. I'm Dan Lefkowitz, strategist for Morningstar Indexes.
And I'm Christine Benz, Director of Personal Finance and Retirement Planning for Morningstar.
Our guest this week is Vincent Maggiore. Vince is a portfolio manager at Fidelity, where he manages the Overseas Fund. The strategy is highly regarded by Morningstar's manager research team. Prior to taking over Fidelity Overseas in 2012, Vince ran Fidelity Select Banking from June 2008. He joined Fidelity as an equity analyst in 2004. Vince has a bachelor's from the University of Pennsylvania and an MBA from Columbia Business School. Vince, welcome to The Long View.
Thanks for having me.
Absolutely. So we're recording this interview just a few days after major tariff announcements from the Trump administration, Liberation Day, and we're seeing a lot of market turmoil in response. So given that you run an overseas fund of, companies that are domiciled outside of the U.S. and markets that are, stand to be affected, it'd be interesting to understand how trade policy is sort of affecting your investment thinking and portfolio positioning, if at all.
Yeah, thanks for the question. It's been a busy week. There's a lot going on. And just to kind of step back 50,000 feet, because I think this will be helpful context in the answer directly to your question. The overseas fund strategy and investment philosophy is to buy high quality businesses at attractive valuations. And I look across the world and across geographies to find those businesses. No matter where I find them, I'm focused on businesses with a competitive advantage that have high returns on invested capital, that are run by capable managers. And I wait for these businesses to get attractively priced. So your question on tariffs is a very good one. The outcome of how this is all going to play out is largely geopolitical, largely macro, and somewhat in the too hard bucket. So I don't try to forecast exactly how this is going to play out, where we're going to settle on tariffs. I just think that is not likely to be a profitable exercise, and I think it's just very complex. But what I do is I take that investment philosophy of high quality businesses, attractive valuations, and I wait for dislocations in the market like the one we're currently in to kind of sharpen our pencils here at Fidelity, to have the team do a lot of work and to understand, okay, we don't know how this is going to play out, but if we overlay several scenarios on tariffs, which companies are most exposed, which are least exposed, which stocks are indiscriminately selling off, even though they're not, we don't think they're going to be very exposed. And to be honest, that's exactly what we're doing right now. We have a team of analysts at Fidelity all over the world who I'm on calls with all day and also getting inundated in my email with scenario analysis on all their names, on all the holdings in the fund, to try to understand where the market may be getting it wrong and where we have a high quality business that's now a bargain. And if I overlay tariffs, the way we're thinking about it, there's kind of three different hits to the business models. One is obviously the direct tariff hit. We don't know exactly what the tariffs are going to be, but we can do some scenarios around this. And to be honest, being a high quality investor, I'm a little less concerned about the direct impact of tariffs. And the reason being is if two best defense against tariffs are a high gross profit margin and pricing power. And the reason being is the tariff is going to be applied to your cost of goods sold. So obviously, if you have a high gross profit margin, you have a low cost of goods sold. So the number that's getting tariffed is quite small in the grand scheme of things. And the amount you need to raise prices to offset it, if you have let's say a 70% gross profit margin, is you still have to hike prices to offset it, but it's not at such a level that should dramatically alter the demand equation. So that's the first step. And we're going through all our portfolio companies to understand, okay, can they pass it through? Do they have pricing power? And how much would they have to pass it through? And again, for that, the fund being, in mostly competitively advantaged businesses with high gross profit margins, we're weathering that, or we think we're going to weather that fairly well. The second is where there could be market share shifts. And this would be, to use a very simplistic example, this would be a duopoly industry, one US player and one player in Europe. And the US player has 100% of their capacity in the US, and the European player has 100% of their capacity in Europe. So even if you have a good business and it's in Europe, and it has historically had pricing power, what the tariff has just done is essentially altered the cost curve within the industry. And the US player is now going to have an advantage. So the European player will find it very difficult to pass on that price and not lose market share to the US player. Now, again, that's a very simplistic example. The reality is these supply chains are very complex, and there's a mix of all of this amongst the companies we own. But that's the second one, and we're going through name by name and trying to figure that out as we speak. And then the third one, and this is, to be honest, this is the biggest impact and the most uncertain, is just this second order effect to confidence, the second order effect to investment levels, both at the consumer level and the corporate level. We just think that it's almost inevitable that this is going to freeze investment globally until there's clarity. And this is the recession impact. Are we going to have a recession? Has the probability gone up? How bad is it going to be? And we don't try to forecast with precision, how this is going to play out, but we're stressing all of our businesses for how sensitive is the earnings to a global recession. And what we're finding is some of the selling is somewhat indiscriminate. So we're finding good, resilient, high quality businesses that we think earnings wouldn't even be down in a recession are down 25, 30%. And we're adding some to those. And we're also finding some of our portfolio that is cyclical is down that much, if not more. And maybe the market could have it right, depending how bad the recession is. So this is kind of all real time. That's how we're thinking about tariffs. But again, it's always with that high quality overlay. And is the market allowing us to buy good businesses when they're on sale?
Yeah.
Does Fidelity have an in-house economic team that you can lean on in times like this to kind of handicap the odds of a recession? What are your resources from that standpoint?
We do. We have a team that thinks about the macro every day and asset allocates around a view. The individual portfolio manager at Fidelity can use that information, but to be perfectly honest, it's informative as it relates to where are we today. So what's happening with credit spreads, what's happening with fiscal expansion or austerity, what's happening with rates. It's very informative for a bottoms-up stock picker just to understand where are we in the cycle. Are we high in the cycle? Are we low in the cycle? Are rates high or rates low? Is there risk appetite or is there risk aversion? Are credit spreads starting to blow out or are they benign? So I use those indicators more to tell me where we are today and to overlay an informed base case on the securities in the portfolio. And I use it less as a forecast of where we're going because I've found the macro, this is not a macro fund. It's not constructed on a view of where the macro is going. There's always a healthy balance of stability and cyclicality within the fund without trying to be too tilted one way or the other. My job is to find attractively priced securities that I think have something unique about them, about the business model, about the industry, about the competitive advantage that will allow them to compound value intrinsically at a double-digit rate over time. And I use these dislocations to step in to these businesses when others are fleeing them and when liquidity is available. But I don't heavily rely on macro forecasts, even though we do have those experts here at Fidelity. But I do kind of real time use them as a gauge for what's going on and how that may change some of my scenario analysis in the fund.
Interesting. Well, this is not your first crisis. You managed the banking fund during 2008 period. Curious if you learned anything from that experience that sort of guides you during these big periods of market turbulence.
Yeah, so I joke that I've kind of been on rotating crisis kind of sectors and products my entire career. I covered industrials at the peak of 06, 07, right before things started to turn. Then picked up the banks, which I'll get to, which was an incredible learning experience, but a stressful one through the crisis here, covering large cap banks for Fidelity and trying to navigate that crisis. And then the overseas fund, obviously in January 2012, when we were worried about the euro and then Brexit. So there's always something to be worried about. And there have been several in my career we've had to manage through. The bank one was the most acute, probably the scariest, because the things we were dealing with were unprecedented. And it was very hard to look back in history and say, well, we've seen this before. This is how it may play out. Let's overlay this scenario. So the banks, the lessons were numerous, but there's a couple that I think have kind of shaped the type of investor I am today. Again, if you hear what I'll say over and over again during the podcast, I do gravitate very heavily to high quality businesses, good balance sheets, cash generative businesses, businesses with a competitive advantage, and businesses that are run by managers and run like owners. And many times a lot of the managers are significant owners in the stock. They invest for the long term. So if you go back to the financial crisis, a lot of what I learned kind of shaped a little bit of that philosophy. So we were covering the U.S. banks, and we were trying to understand where the bodies were buried, who had the bad stuff on the balance sheet. And what we were doing as a team was we were running stress tests on all the balance sheets. We were basically trying to understand what the embedded loss was in each of the loan books and the portfolios. And we were trying to burn these books, we would call them, or burn down the losses to understand real time, what does the earnings profile and the capital level look like in a significantly stressed scenario. And ironically, the Fed actually in a way copied what we're doing, and we still have stress tests today, but this was not a part of the banking regulatory system back then. This is what we were doing stock by stock to try to understand, because at the end of the day, what we soon and very quickly realized was if you realize a bank needs capital, if it's deficient of capital or if it's too levered, it's uninvestable. Stay away. We learned that in some cases the hard way, because what happens when a bank is short of capital and the market sniffs it out and knows it is the shorts can actually make the whole thing self-fulfilling, and they can drive the stock lower, because once the market knows you need capital and you can put your arms around how big the capital hole is, the dilution becomes much more significant the lower the stock goes. So you have this circularity. And what I like situations where the lower the stock goes, the cheaper it is and the more I like it. But with heavily levered institutions, i.e. banks, you can be a scenario where the lower it goes, the less it's actually worth on a per share basis because of the dilution. And that was an important lesson to learn. And I think to this day, it's kept me away from very highly levered stocks, both banks, but also just, regular industrial businesses that are cyclical. If you have a lot of operating leverage inherent in your business, there really is no need for that financial leverage where you have even a remote risk of diluting the equity holders significantly at the bottom. So that was probably the appreciation for downside risk and the appreciation for leverage not giving you that margin of safety you need to add on weakness are probably two of the most important lessons we learned. And also navigating a crisis where we don't have historical precedent creates a lot of innovative and creative analysis and thinking and being plugged in with key decision makers and understanding how they're thinking of solving something that we haven't had to solve before. So, establishing that network was super important than just sitting in your office and, running scenario analysis. So probably the combination of all things, building a robust Rolodex and then appreciating downside risk and dilution at the bottom were kind of big lessons that I think have shaped a little bit of that quality bent that I have today.
Our Morningstar manager research analysts who cover your fund describe you as deliberate about combating behavioral biases. Could you talk about those behavioral risks and how you mitigate them in managing the portfolio?
Yeah. So there are a number of kind of human behavioral biases that I think make us, on average, poor investors. And I'm conscious of those. And I'm not saying I don't have them, but I try to create a system by which I don't fall into some traps. The first one that I think, and I've seen it here at Fidelity, having been here now for 20 years, is the very common mistake that I make and that portfolio managers make, which is thesis creep. And what this essentially is, and particularly at Fidelity, when you have amazing access to your CEOs and CFOs that come through here every day, and they want to meet with us and they want to tell their story, it's extremely important to be rooted in the original underlying investment thesis of the stock. Why did you buy it? What do you think is going to play out over the next 2 to 3 years? How do you value it? And what do you think the range of intrinsic value is for the stock? And I have this, it sounds simple, but I have these core tenets of every thesis for every stock I've ever purchased in the overseas fund going back now almost 14 years. And it's chronological and it's quite detailed. And what it does is it anchors me in my belief system. So why do I own the stock? What is the core thesis? Because what eventually happens is when things start working against you on a stock and things, the earnings may not be developing the way you thought, management comes in, they try to tell you why you shouldn't panic, why it's near term, why it's temporary. Sometimes the analysts may be swayed one way or another, but it all comes down to the original thesis. And if I see that we're deviating from that, either my estimate of intrinsic value is different or the competitive advantage that we once thought the business had is no longer valid, there's a competitive intensity we didn't appreciate. If there's something that's changing the terminal value of the business, then I am very inclined to look at that journal that I've created over time. And if I see there's a deviation between the journal and where the story is going or what's happening in the industry, I'm very inclined to sell. And I don't like selling when it's down, but more often than not, when there's been a change in the thesis, even if the stock is below where I purchased it, I am open to selling because that is one of the biggest traps. I think you can follow the stock even much lower, if you're not intellectually honest with exactly what the original thesis was and if it's still intact. The second one that I think is common amongst investors that are highly concentrated is that you get wedded to your positions and you get emotionally wedded to your positions. And what I mean by that is it becomes quite dangerous because at all times, I'm trying to make the right probabilistic decision. And I think that's very difficult to do when you're all in on 4, 5, 6, 7, 8, 9, 10 names, right? Superly concentrated portfolio. And the analogy I use in my head, or I like to use when I talk to potential investors in the overseas fund, is if I gave you the proposition heads, you win 5 times your net worth, but tails, you lose your entire net worth. I don't think anyone would take that bet, right? The downside risk of losing your entire net worth is massive. But the expected value of that is positive, right? Like probabilistically, it's probably not a bad bet, but it's a terrible bet if the stakes are just too high. And I use that example because if you have, your fund in 10% of your fund in one position, and that position is down 30% in any given day, and all of your math is saying you should double the position size, more often than not, you're frozen because you likely just lost your performance here on one stock in one day. And I find it very difficult for myself, at least, to make the right probabilistic decision when I'm too heavily concentrated in a select few names. And that's kind of impacted portfolio construction at Overseas Fund. I have gotten more concentrated over the years, just through, truly betting with conviction on names that I know and I've known for many years or where I've gotten better for many years. So concentration has gone up, but it's not at a level where I'm emotionally tied to the stocks where I think I'm going to make the wrong probabilistic decision at any given point in time, if that makes sense.
Yeah. I'm just looking at your portfolio, like the top position is just like 330 basis points. And that's really the only position you have over 3% as of the end of February. So quite diffuse. I suppose it'd be different if you had a more concentrated benchmark though, right?
That's true. So it's the MSCI EFA benchmark. It's a developed market ex-US product. And it's very different from the US. We don't have the MAG 7. So, I don't know the exact number, but the biggest weight in the index would be around 2.5%. And then after the top 10 or 15, it drops pretty rapidly. Whereas in the US, you have, 7, 8, 9% index weight positions. So the fund is really driven by what I own and much less on what I don't own. And I actually like that because the work we do is on quality businesses that we own and we know them really well. We always look at the big underweights that we have, but you really want what you own to drive the performance, not what you don't. And not in every year, but in most years, that's how the flatness of the index kind of is set up.
You mentioned the access that you get to management at Fidelity, and management meetings are just a kind of a classic Fidelity aspect of the investment process. Are they for you? What role do they play in your investment process?
So it's extremely important to meet management because when I define quality, it's the underlying quality of the business. Does the business have a competitive advantage? Does it generate high returns on capital? Do they have an ability to reinvest their cash flow at those high returns? And are those returns sustainable over time? But if you take one of the lessons learned, and again, I keep going back to kind of behavioral biases, I keep a lessons learned journal. It's quite depressing to read every year, but it is where did I make my mistakes? And how do I make one less mistake every year? And that's what I'm trying to do with the lessons learned journal. And one of the lessons learned, and again, this is tied to meeting management, was you can have an amazing business, but if the management team takes those cash flows and then deploys them in a way that is value destructive, the entire thesis is turned on its head. So it's not good enough to have a good business. In my mind, you have to have a management team that thinks like an owner and manages a business like an owner. And that's the simplest way I can put it. There are many different things we check to kind of verify that. But at the end of the day, it's almost as if you want a family-owned business. You want someone who gets up every day, is investing for the long term, is tied to the right KPIs. And again, it's not EBITDA growth, right? There has to be a capital charge associated with that growth. Do they understand the capital intensity of the business? Are they getting good returns on the capital allocation, both organically, but also equally important, inorganically? Are they paying too much for deals? When we interview a management team, one of the things we always do is we bring up a recent deal that they did, particularly if it was large. And if you're a management team that thinks like an owner and you're compensated on metrics like return on capital and per share metrics, you're going to know exactly what you paid for that deal. You're going to know exactly what the cash flow you're going to be able to generate from that acquisition is in year 3, 4, and 5. And you're going to know what your pre and after tax return on that deal is. And you're going to know how much of it is based on cost synergies, which should be in the bag, versus revenue synergies, which, as we all know, likely are much harder to get and don't come through. And when we interview our management teams, it's clear as day that some of them are not able to tie the acquisition back to these key metrics. And that tells us they're just buying growth and they don't really think like owners. And others are enormously impressive down to the minutia and the detail and understanding exactly what they bought, why it fits in strategically, and why the cash on cash return is well into the double digits, looking out 3 to 5 years. The fund owns many serial acquirers. And we've been taught, in business school that acquisitions don't create value, stay away.
Mm-hmm.
And I would largely agree with that for large acquisitions, meaning when you're buying more than 30 or 40% of your current EBITDA. Those are very difficult to integrate. There's cultural issues with integrating the two businesses. More often than not, those don't go well. But there's lots of interesting small, mid-cap niche businesses in the fund that are very high quality, have a nice organic business that grows a little bit. But then they take the cash flows from that and they reinvest these in rolling up a highly fragmented industry at very, very attractive prices. Some of them paying 5, 6, 7 times EBIT to roll up the industry. And as a public market investor, I can't buy good assets at 7 times EBIT. They don't exist. Although a couple more weeks like the one we just had, maybe they will exist very soon. But there are plenty of these in the fund. And then meeting management gets you in their head a little bit in how they're rolling up the industry. Why has it been a good deal? So the first meeting with management when I establish a new position or I'm about to establish a new position is by far the most important meeting with management. Subsequent meetings with management are just a little bit of a check the box, go back to the journal. Is the thesis on track? And they're important, but it's a little bit more of just continuous due diligence. It's the first meeting where you really can get your hands dirty, roll up your sleeves and understand, is it a high quality business and does management understand how to allocate capital?
We want to delve into the fund that you run, Fidelity Overseas. You took over the fund in 2012, which was the early days of what has been quite a long run of dominance for U.S. equities. Has it been frustrating to focus on an out-of-favor asset class as non-U.S. equities have been during most of this period?
I mean, so frustrating is a strong word. I think deeply about my shareholders, and I want them to get the best return both relative to the index, but absolute as well, because as we all know, relative doesn't put real dollars in your pocket. So there's an element of frustration there. But what I'm trying to do, that's a little bit out of my control because, the people picking the fund want exposure to international. They want to diversify out of US, which makes perfect sense. It hasn't always been this way. There was a period during 2002 to 2007 where international outperformed US. Sometimes you want diversity of currencies rather than just being the US. So there are plenty of reasons to have a portion, as a US investor, to have a portion of your allocation international. Do I wish it did better over the last 10 years? I do, but I'm also trying my best to outperform what the index is doing. And over time, when I look at the types of quality companies I own, I look at the valuations that we're presented with today, I do believe that shareholders in the fund will have an adequate return. It's impossible to know exactly what it would be. But I do think from this starting point, with the quality of companies I own, the setup is decent with a very long-term view to compound value. And that's what I'm trying to do. And I'm trying to do that in excess of the index. It won't happen every year in excess of the index, but over time, that's essentially what I'm trying to do. When you compare it to the US, though, it's a very different index. And I think the investors need to be aware of this. It's much less tech. So the earnings growth has lagged. And it's a little bit more of the old economies. It's a little bit more heavily on banks, a little bit more heavily on energy and commodities. There is a tech element, but it's obviously much smaller. There's a big heavy industrials element to it, which is bigger than the US. So the sector composition is very, very different. The earnings growth has been different, and we haven't had the tailwind of the Mag 7, which in hindsight was obviously negative, but on a go-forward basis is very hard to call. We'll see. So it's a different sectorial positions, different types of companies. But there are globally dominant businesses at attractive valuations in international. And that's where I'm trying to make sure my shareholders have exposure to so that we can do the best we can over the coming 3 and 5 years.
Yeah. Well, there was a sort of a performance rotation in the first quarter with stocks outside of the U.S. Leading U.S. equities, and Europe was a real bright spot there. Curious if you were surprised at all by that rotation. I suppose, a quarter-to-quarter basis, you've seen sort of leadership flip-flop.
Yeah, I mean, it's really hard to call some of these near-term swings, and I don't focus a lot on it. I really am stock by stock, trying to get the best combination of quality, growth, and valuation within the fund. Um, but you're right. We had a good start and it's been a volatile week. So we'll see where we end up.
Right.
But there has been a rotation out of the US. I can come up with some reasons as to why that is. It's very hard to know if it's sustainable. And I don't claim to have, a strong opinion or view there. But there are some things changing on the ground in Europe. And I think part of it had to do with that. So one, I do think that the US was probably a little bit crowded and a little bit expensive coming into the year. Now, again, there's been big sell-offs. So, things are changing rapidly. But when you overlay that with an index that had re-rated in the US, where we were kind of at our average P over the last 10 years in EFA, I think there was a valuation argument that you can make that was maybe high relative to where we've been at any point historically. So I think when you have those types of valuation markets, it's just easier to see money flow from one market to the other. But even more importantly than that, on the ground, you're seeing some change in Europe for the first time in a long time. So the US is having some fiscal austerity with Doge and cutting government projects and trying to balance the budget. And Europe or Germany has one of the best fiscal balance sheets or sovereign balance sheets in the world. They're at 80% debt to GDP, plenty of room, but they haven't expanded their balance sheet and they haven't had fiscal expansion in 10 years or 15 years. So they're now going the other way. And the elections kind of prove that the people are okay with this, are okay with letting some of the purse strings loose. There's spending on infrastructure, spending on defense, reducing that austerity mindset. And I think that is positive for European growth, at least in a relative context, versus some other parts of the world. And the other part of that, so that absolutely has ramifications for companies that are in the industrial sector, in the building products sector that sell products into some of the infrastructure spending, and then obviously the defense sector. And the fund has exposure to all three of these categories in Europe, which, again, things are changing with the tariffs on a daily basis, but I still think are going to be a relatively better off place to be in Europe, just given the visibility we have on that fiscal expansion in Germany and how it'll trickle down and have a multiplier effect. But the second thing also is when Germany starts spending, and we saw this a little bit in the bond yield, you're going to start see rates back up or at least stay higher for longer. Now, obviously with recession risk, that's a counteracting balance to rates. So we'll see where we end up, but all things equal or all things being considered, it is likely that rates are going to be higher and we're never going back to kind of negative rates like we saw for 10 years in Europe. And that has ramifications for banks and insurance companies in Europe. These are big parts of the market and they are very sensitive in terms of the return on equity they can generate depending on where the yield curve is and where rates are. And it does feel likely rates are going to be higher. So those two sectors probably have a lot of earnings power, a lot of capital return and very attractive valuations. And that's helping a little bit of that European market versus the US dynamic that you mentioned so far year to date. And then the last one we mentioned was defense. Obviously, they're going to spend a lot on defense. I think that there was a bit of a wake-up call that they don't have, the US to rely on the way maybe they had for the past 10, 20 years. And they've had decades of underspending. So not only do they need to get back to baseline, they probably need to go above it for a period of time to rearm Europe, which is currently spending about 2% of GDP on defense, and that could go north of 3% over the next 10 years. So lots of visibility and a lot of spending there. So those are just some, again, it's all bottoms up for me, but there are some kind of big tectonic plates that are shifting that haven't moved in a while that are positive for sectors and businesses within Europe. And I think that's part of that rotation.
You, in the overseas portfolio, you do have some exposure to what are known as the granola stocks. I don't know if it's really caught on, but it was an acronym, kind of Europe's answer to the Mag 7 or the FANG stocks, these growth companies like ASML and Novo Nordisk, LVMH. Do you find that acronym useful at all? They seem to be kind of quality companies that would be in your wheelhouse.
Yeah, so I don't love acronyms and I don't spend a lot of time on acronyms, but they're catchy and I get why the market likes to kind of gravitate to them. I actually had to look up which stocks were in granola. That's how little time I spend on kind of acronyms, but I spent a lot of time on stocks and I know a lot of stocks that are kind of make up that acronym. So you have GSK, Roche, ASML, Nestle, Novartis, a lot of the large cap companies in Europe and a lot of decent quality companies. So, my wish list and my sandbox is much bigger than this subset of companies. And I own or I have meaningful bets in two of the, say, 7 or 8 names that make up this acronym. The two would be ASML and SAP. And if you just go back to kind of the original premise of what I'm trying to do for my shareholders, buy very high quality businesses at attractive valuations. And I define quality by the underlying business quality, management quality, and the growth prospects. This isn't a, quality with no growth. It is, I definitely do, I'm trying to optimize high quality, high return on capital, good growth prospects, but not pay up for them. And if you think about those two stocks, ASML is a perfect example of this. It's a monopoly business. So think about that. There are no competitors. So quality for me is a rational competitive set where you have a competitive advantage. There are very few instances where you don't really have, especially on leading edge EUV lithography, a legitimate competitor. And that's because of just how complex it is to make their EUV lithography machines. So they have a very advantageous position within the semi-cap supply chain. The problem with ASML is not the quality of the business. It's fantastic, very high margins, pricing power, and mission critical. When you think about leading edge semiconductor manufacturing, it'd be impossible to do without their equipment. So it has many of the attributes we look for in a very long-term, intrinsically valued compounding asset. The problem is near term. The problem is cyclicality. Obviously, people are very worried about the semi cycle, and they rightfully so. We could be on the cusp of even more pain, although it's been a very slow semi cycle. We could be on the cusp of more pain because at the end of the day, it is tied to GDP. These are things that go into PCs and mobile smartphones and servers and the AI complex. But over time, the cyclicality will work itself out. And then the positive attributes of the business in a positive cycle will hopefully be valued appropriately. And we think now is a very interesting time to look at ASML, given the quality of the business and given the fact that the stock is down substantially and is now trading at valuations that we haven't seen in some time. So that is a name that the fund owns. And again, it does check the quality, growth, and valuation box for the fund. And we think it has, it's very well positioned. And after this sell-off, potentially attractively priced, depending on the scenarios that play out. The SAP is another one. This is a business. We were always attracted to the quality of the software and how mission critical it is within a company when they were a licensing business, meaning on-premise. But we became much more interested in the business as they transitioned to the cloud. The business to us is a much more valuable cash flow stream in the cloud than it was on-premise, meaning it is equally as mission critical, just as sticky, but potentially much more lucrative. $1 of spending on premise could be north of $3 on the cloud. So you have this tremendous upsell opportunity as they transition their install base to the cloud. Again, I mentioned it's extremely mission critical. And what SAP has, which others don't, is they have access to extremely important data for their customers and their clients. And what they can do with that, if they were to overlay, and they are overlaying AI, into that pool of data and mission critical data and how businesses are managing the business every day and supply chains. Think about how complex supply chains are getting in tariffs and all these things. What SAP can do in the cloud and overlaying AI is significantly improving their customer value proposition. And at the end of the day, you have a good asset, mission critical, extremely sticky, transitioning onto the cloud, which makes going from a good business, we think, to a great business. And we think the upsell opportunity is significant. And we think that their customer value proposition, even with that upsell opportunity, is probably getting more important and more impressive than it was. Now, this one hasn't, the evaluation it's re-rated versus the old SAP. So this is a trickier one. You have to have a view on what this all means looking out at 3 to 5 years, which we're modeling out, trying to understand what does it mean for margins? What does it mean for growth? What does it mean for cash flows? But we do own this one and we quite like it. Those are the two within that granola acronym, particularly after the sell-off in this last week, that the fund continues to own.
I guess it's granolas with an S at the end, and SAP is the S at the end.
You referenced AI just now in the context of those companies. It was obviously the main investment theme powering the bull market in 2023 and 2024. We'd like to get your take on how you're thinking about AI and its impact and how it's influencing your decision-making throughout the portfolio, not just with those companies that play directly in that space. Maybe you can talk about that.
Yeah. And the good news, I'll give you my views. It's not Fidelity's views, but the good news about being an international fund manager at Fidelity is we have a tremendous tech team domestically. Obviously, we have our international tech team, but we're able to kind of cross-check what our international companies are saying with what Microsoft is saying or what Google is saying or what the semi-cap equipment players that are domiciled in the US are saying. And so we have views from all over the world. that kind of can chime in on AI and give their take on what it means for their companies, what it means for our analysts covering NVIDIA. And then you can take that as a bit of a mosaic and put the pieces together for how you're overlaying it into Europe and Japan. So I'll give you my own personal view. The long term is much clearer than the short term for AI. The long term, I do believe, is a fundamental technological change that is going to change the way businesses run and the way we conduct our daily lives, both at work and at home. I think it's going to be significant and embedded throughout everything we do. It's going to help solve problems. It's going to create efficiencies where things were more labor intensive. I'm very bullish on the application of this long term and the democratization of AI. And the cheaper AI gets, I think the quicker we're going to see this adoption. So long term, I'm actually quite bullish. But I have to caveat that by saying the near term is very hard to figure out. And what I mean by that is there are two beneficiaries of AI, near term and long term for that matter. One are the picks and shovels. These are the companies that are going to build out the infrastructure we need for AI. Think semiconductor equipment companies, TSMCs of the world. There are also companies that make transformers and electrical products that need to go into data centers, that need to upgrade the grid for the new power intensity. There's a whole value chain that's all tied into this that has benefited tremendously so far from the massive scaling up at the hyperscalers. So the hyperscaler CapEx has gone up about 300% since 2021. That is a massive increase in capital intensity at the US hyperscalers. And all of these companies have benefited. And what's tricky to understand is from here, did they pre-build? And what I mean by that is the compute efficiency is increasing at such a rate. And especially after the DeepSeek news that we got, it's very hard to understand if they pre-built and we have to grow into this capacity with the increasing compute efficiency that we're seeing across AI models and inference. And also, if we're going to see a period or a lull in CapEx, the hyperscalers, as they kind of grow in or fill up this capacity. And as we move from training to inference, if the applications aren't there, meaning I think AI is going to be embedded in everything we do long term, but I can't say it's part of my daily life today. It's a bit of a chicken before the egg. If we don't have the enterprise applications there ready to absorb that capacity, you could have a period of time where you have a down cycle before the upcycle begins again. And that's why I find some of these names that are kind of the hardware plays that go into the build out to be a little bit hard to figure out at the moment, meaning are we going to plow through it? And, are we going to see a massive expansion of use cases? In that case, we're fine. Or do we have a valley first that we need to work our way through? One area that is obvious to me, though, is the beneficiaries of AI are the ones, and we mentioned this a little bit with SAP, are the ones that have unique data sets that are going to be able to benefit from the increasing compute efficiency or decreasing cost of compute and overlay that onto those data sets and create a better product for their customers. And the fund owns several of these, and this is less of a question mark in my mind. SAP is obviously, I think, a potential beneficiary of these dynamics, but there's a company called Relics in the UK. They have very unique data sets that are sold to lawyers as well as to universities. This is a business that is being extremely innovative on the AI front and making their product better with their unique data sets. There's a company called LSE, which has market data, a significant amount of real-time market data, and they're partnering with Microsoft where we think they're going to overlay AI and make their customer value proposition significantly better than it currently is. So that's kind of how I'm dissecting the AI. I believe in it long term. Very difficult to know about the infrastructure plays in the short to medium term, but the beneficiaries are the ones that have the data and are making their product better. And the fund has a mix of both today. I'm still in some of the picks and shovels. The reason being is some of these have sold off so much that you don't have to be as bullish, even with that valley we talked about or some pause in spending. Some of these I think have overdone the sell-off and can be potentially attractive. So I have exposure to both, but the second bucket are the ones that today, to me, are the clearest beneficiaries.
We wanted to ask you about Japan. Hitachi is in your top 10. You have a number of Japanese holdings in the overseas portfolio. We've sort of gotten different responses from fund managers on Japan. Some see a real sort of change in corporate governance and a renaissance, and macro backdrop has improved. Others feel like it's another false dawn. we know you're a stock picker, but in your management meetings and your analysis of capital allocation amongst Japanese companies, what are you seeing?
So it's a timely question. I was in Japan about a month ago, and we go several times a year, and a lot of them come through Boston. So we're quite up to date on how our management thinking, not only how they're thinking today, but how it's evolved, which is almost more important. Is it actually changing? To your question, is something fundamentally changing? And I
Yeah.
would say there is a true underlying fundamental change in how Japan corporates view corporate governance. And I would say when I picked up this fund, 13 years ago, we'd get to the capital allocation discussion and we'd ask, why do you have 30% of your market cap in cash, earning nothing at a Japanese mega bank? Why don't you give that back to shareholders? It's depressing your ROE. And we kind of felt like they would give us a response, but it was a very canned response. And I don't know if they actually believed that they were ever going to do anything with that cash. And that's kind of how we valued it and how we viewed it. And fast forward to today, or even a month ago when I was in Tokyo, every single meeting was very interactive on the capital allocation front. And the corporates were asking us, what should they do? What is the right mix of buybacks? What is the right mix of dividends? How much cash should we hold on the balance sheet? They're obviously very conservative companies in Japan, so they don't want to lever up the balance sheet. But I'll tell you, levering up the balance sheet is different, and I'm not sure we're going to go that far. But just to stop accumulating cash and to sell cross shareholdings you have in other companies can dramatically improve your ROE. And to buy back stock on an undervalued stock with those proceeds is extremely value enhancing. And we're seeing it across our companies. So, you mentioned Hitachi. That's a really good example. This was a very is to some degree still a very complicated conglomerate that was in too many businesses, some good, some mediocre. And it was very unclear where they were allocating capital and what the mediocre businesses, what their prospects were in a 3 to 5 year view. And management has completely changed focus here, where they're investing in their best businesses that have the best growth prospects. They're divesting businesses. They divested Hitachi Metals and Hitachi Construction. We actually think they're potentially not even at the end of this. There's more that they could potentially divest. As they free up this capital, obviously their ROEs are going up. And with the proceeds, they're giving you dividends and potentially buybacks. So this is real change. It's simplifying the business. It's improving the ROE of the business. And they're running the business and they're focusing on where they have a competitive advantage, which to us is IT services, which is the bulk of their core business, mainly in Japan. They have a great business and it's somewhat insulated from all the macro cross currents we're having to deal with today. And then the second would be on high voltage transformers, where they're also dominant. It's a highly consolidated industry. And they're benefiting from the AI build out as you need to upgrade the grid and utilities need to spend. They're almost a consultant relationship with these builders where they're selling the transformer, but also a service contract attached. So Hitachi is a business that we think is headed in the right direction. They're simplifying, they're focused on the right things. Another one is Tokyo Marine, which is an insurance company. This business does have significant cross shareholdings, which is essentially when a Japanese company would own equities of customers or other Japanese companies on the balance sheet. Obviously, that's a low return balance sheet item. It just kind of sits there. It drags down your return on equity. It's not productive capital. We'd much rather have that capital back as shareholders or have the businesses reinvested into growth. And Tokyo Marine is a very high quality P&C insurer in Japan. Half of the business is Japan, half international, where they have a history of managing the business extremely well with improving ROEs. They're reducing their cross shareholdings down to zero between now and 2030, or claim they will. And what that's going to do is free up a significant amount of excess capital as a percent of their market cap. And we're hopeful with that excess capital that they'll do smart things like increase dividends progressively and also buy back the stock, which looks quite attractive after the sell-off we saw in Japan over the last couple of days. So there's other examples as well, but I'm seeing much more positive change than we've seen in a long time in Japan. And again, it's stock by stock. It's not a buy the whole market comment, but we are finding ideas stock by stock where we're seeing positive change. Businesses focus on ROE, simplification, and share buybacks, which is a big change.
We wanted to ask about how currency fits into all of this. The US dollar had been very strong until quite recently. Can you talk about how, or maybe how not, currency fluctuations affect how you manage the portfolio?
Yeah. So we don't have a view on currency and we don't hedge currency. So that's kind of the 50,000 foot view, but we are currency aware. So I'll define what that means. The way I think about currency is most of the businesses I own are global in nature. So just because a business is domiciled in Switzerland, the Swiss franc is not really of relevance to a multinational domiciled in Switzerland. It's where they get their cash flows. And to the extent it's a global business, the business itself is somewhat hedged on the currency. And at the end of the day, we're looking for hard currency returns because that's what my shareholders, at the end of the day, when they convert that back to US dollars, that's what they need to spend. That's where they need to create their wealth. So everything we're doing is with an eye towards, can this business give us strong US dollar returns? So in the first instance, if it's a global business with highly diverse cash flow streams from all over the world, we're a little bit less concerned about currency movements because they net likely wash over time. We look at what the currency headwind has been in US dollars over the last, call it 5 and 10 years, and we try to buy businesses where the IRR is high enough to outrun a scenario of modest currency depreciation in US dollars when you convert it back to hard currency. Those we're less concerned about. And like I said, the global nature of the business kind of hedges itself. Where you have to really sharpen your pencil in currencies are two places. One is a domestic-oriented business. So say a business where that is 100% tied to the UK. We had to do a lot of scenario analysis when Brexit was happening around what this meant for our UK-heavy businesses that were relying on the UK for their revenue, almost 100%. And with these, you truly eat the currency in your return. You don't have that global hedge of the cash flows being all over the world. So you have to kind of overlay scenarios on what do we think about the pound. And for developed markets, we don't assume massive currency depreciation. But as we've seen in Japan and in other developed markets, you could have a healthy multi-year headwind on currency. So what we try to do is shine a light on the one country company where the US dollar return is completely tied to that currency. And we try to make sure that our embedded IRR, or the degree at which the stock is undervalued, is significant enough to offset most scenarios, even if we're offsides in the currency. And that's how we deal with those. Are the ones where you really have to sharpen your pencil. The global ones, a little less so. The domestic-oriented ones, you really have to say, okay, is this worth playing for if I'm just getting an 8% low-risk IRR, but we think the currency has a chance of going down 3 to 4 a year, in dollars, that's not good enough for my shareholder. And then the third bucket where you really have to sharpen your pencil, and it's part of the reason I've historically not had a significant weighting in emerging markets, are the EM currencies. The EM currencies can be much, much more volatile. Again, it's a developed market fund, so I don't have to be there on EM. And the bar is very high on corporate governance, and the bar is very high on IRR, on base case IRR, meaning I need to outrun a pretty conservative scenario of currency depreciation and still give my shareholders a strong US dollar return. And with the bar being that high for EM, and given the historical currency volatility, particularly in places like LATAM, it's just not a place I've gravitated to, nor is it a place I've historically had a heavy weighting in. Now, all that being said, I do own some EM stocks. I think there are some really interesting dominant EM bank franchises that are very low credit penetration, have lower than average FX risk to what we're talking about, have dominant business models, say north of 20% ROEs, have very good growth prospects, and are now trading after this recent sell-off at valuations we haven't seen in over a decade. So there are opportunities, and some of them are actually quite low risk, we think, with very healthy IRRs that can outrun currency depreciation. But for the most part, that third bucket, EM, the bar is so high on governance and currency that it rarely makes it through the funnel into new ideas. So it does tend to weigh much more developed markets in the fund.
Well, Vince, I think we only have time for one more, but I did want to ask you about your colleagues at Fidelity and sort of how you interact with them. You mentioned leveraging the analyst team and the macroeconomic researchers as well, but you're part of a very long tenured group of Fidelity managers focused on international. Bill Bauer and Bill Kennedy and Sammy Simnagar and Jed Weiss, and you've got the Will Danoffs of the world on the domestic side. I'm just kind of curious, day to day, are you bouncing ideas off of them? I guess in some ways they're kind of the competition. How do you see it?
Yeah, we don't view ourselves as competition. We're all running Fidelity funds. We're trying to do the best for our shareholders, and we're a team. It is exactly how it operates. I sit next to Bill Bauer. I'm in between Bill Bauer and Bill Kennedy. And Sammy is across the hall. And I have a conversation with that team, and Jed Weiss, for that matter, who's on the growth side, and Alex on the value side. And we all have different investment philosophies. So I'm not saying we're extremely like-minded on everything we do, and we're not analyzing situations exactly the same, but that's actually the beauty of the team, is I think we're asking different questions and we're buying different things on this sell-off. Light bulbs go off and say, I hadn't thought about that, or I hadn't really thought about that risk to tariffs in my portfolio. So, I mean, just for example, the other day when the market was melting on the announcement on tariffs from the president, we all had a PM emergency lunch where we sat together and we discussed what we're doing, where we're seeing opportunities, and how we think this is likely to play out. So there's a lot of that happening at the team level, at the PM level. And I think I'm a huge beneficiary of that and being on this team at Fidelity, because there are people I've been on this fund now, this is my 14th year. There are people who are on 30 years, right? And I've seen a lot of cycles. They've seen, unfortunately, probably 2 or 3 more than me. And that historical understanding and knowledge is just invaluable when you're going through periods of stress, to just kind of understand, okay, let's step back, let's take a deep breath. What are we all thinking? And have we all kind of exhausted all the different scenarios? That's at the PM level. And then there's the analyst team. And, I lived in London for 3 years as we were building out that London office in a more robust way. And a lot of those analysts that, were there back then, I was there in 2012 to 2015, are still there. They've now become senior analysts. They are mentors and thought leaders within that office. I'm in a constant daily interaction with that office. And then Tokyo, the time horizon is a bit challenging, and same for Hong Kong. So I wouldn't say it's as daily, but they're in my inbox, they're in my teams. We're extremely up to date on what all the analysts are thinking real time. And most importantly, when something's actionable, do they think that I should be doing something differently than what I'm doing? There's a seamless communication and interaction across the offices to kind of get on my calendar very quickly, and we can have a discussion about it. Right before this podcast, I did a half-hour call with our tech analyst in London, and we talked about how he's thinking about things, but equally, he had questions for me on how I'm thinking about it, because he's extremely smart and he's an incredible investor, but he hadn't lived through many crises, as many as I have, unfortunately. So there was a lot of back and forth that I was trying to talk through to him. Is it too late to get defensive? What has been your historical experience when you've seen such sharp sell-off this quickly? What are you buying today? What are you gravitating? Just going back and forth and exchanging ideas. And that happens on a daily basis. And I just think it is a very team-oriented culture amongst the PMs and the analysts, where we're all just trying to do the best for our shareholders. And the only way to do that is to think out loud, to learn out loud, to talk out loud. And that's the environment and the culture we're trying to foster here at Fidelity on the international team.
Well, this has been great. Thanks so much for joining us in the long view, Vince.
Yeah, no, I was happy to do it. It was a fun conversation. Thanks for the questions.
Thanks so much, Vince.
Thank you for joining us on The Long View. If you could, please take a moment to subscribe to and rate the podcast on Apple, Spotify, or wherever you get your podcasts. You can follow us on socials at Dan Lefkowitz on LinkedIn,
And at Christine_Benz on X, or Christine Benz on LinkedIn.
George Cassidy is our engineer for the podcast, and Carrie Greshik produces the show notes each week. Finally, we'd love to get your feedback. If you have a comment or a guest idea, please email us at thelongview@morningstar.com. Until next time, thanks for joining us.
This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording and are subject to change without notice. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates, which together we refer to as Morningstar. Morningstar is not affiliated with guests or their business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. This recording is for informational purposes only, and the information, data, analysis, or opinion it includes or their use should not be considered investment or tax advice, and therefore is not an offer to buy or sell a security. Morningstar shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data, analyses, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision. Please consult a tax and/or financial professional for advice specific to your individual circumstances.